Welcome to the Mortgage Broker Podcast, tailor-made for Canadian mortgage industry professionals. Proudly presented by a Better Way Mortgage Group, this podcast is your trusted source for insider insights, market updates, and strategies to elevate your career in the ever-evolving world of mortgage brokering. Whether you're a seasoned broker with a Better Way Mortgage Group or an industry enthusiast looking to stay ahead, our episodes are designed to empower you with the knowledge and tools you need to excel in the Canadian mortgage space. Okay, so maybe shifting gears here a bit, I wanted to get into just the pricing complexity and the market dynamics, because if we go back earlier in this year, rates were up and down every single day. It was very difficult to effectively tell your client what rate to expect. Yep. And if you think of a mortgage broker trying to pre-approve a client and give them a price point to go shopping, it was very difficult. Caused a lot of frustration. We had a lot of our agents calling us pretty much every day, like, hey, I found out broker Joe got this rate and I'm getting this rate. And it was like, well, he got that rate quoted to him 3 days ago and yours is today. So just getting into that, because you did a presentation in Quebec City, that was very enlightening for me, very helpful. So I wouldn't mind just jumping into that and how that all works.
Set the stage for that a little bit. I think, the best way to understand pricing is to start with understanding, how banks think about their cost of funds. And so that's what I wanted to sort of go through a little bit here. Banks, unlike, some other participants in the market, like they have a lot of different sources of funding, right? They have deposits, they have covered bonds, they have the NHA MBS program, securitization programs, and they have their own ability to issue bonds to raise funds. So there's lots of different sources of funding. And they also have a lot of different lending that they do. Right. So, all banks have to have some way of bringing order to the cost of funds and transferring that. And they call it transfer pricing. That's really what underpins, people like me trying to run pricing and profitability of the portfolio. It sort of starts with that, the cost of funds, which is based on a transfer pricing methodology. So I wanted to kind of share a bit of the construct of that, kind of how that works, and put that in the context of the year that we've just been through. Hopefully people will understand a little bit better, what's going on behind the scenes that is causing, those pricing experience that you're sort of feeling as a broker and as customers out there in the market, right? So a lot of people talk about, banks' cost of funds. They say, watch the bond market. And that's true. The bank's cost of funds is based on the bond market. And that's the blue line here. We call it the base rate. It's not exactly the bond market. It's a derivative of the bond market. It tracks the bond market. And that's one component of our cost of funds. And people can see that if they follow the bond market, they can get an idea for how this is moving around. The part on the bottom here, the black line, is the second part of the cost of funds, which we call liquidity premium. Most banks have something similar to this, by the way. The point is that there's two components. And the liquidity premium is something that represents the additional risk that the market, attributes to a bank raising funds in a market versus, let's say, the government of Canada, right? Which is more the blue line. So the black line is that additional, say, liquidity premium. Some people call it different things, risk premium, whatever. That's what's represented by this black line at the bottom here. And when you add the two together, you get the red line on the right-hand side here, which is the total overall cost of funds. A couple things just to call out. The blue line is, like I say, the base rate. The market-based rate is hedgeable. So when banks do hedging, they're protecting the blue line. When in a 120-day rate commitment environment, it's very important. If you're making a rate commitment today, by the time that deal funds, you need to be protected that your cost of funds is still going to be the same or close to the same as when you made that rate commitment. Otherwise, your profitability doesn't take much for it to go unfavorable. We have people in Treasury that do that hedging, and it's an important part of every lender's operation because of that 120-day rate commitment, right? And there's a cost to hedging, which is built in.
Yeah.
And the cost of it depends on the market, the volatility of the market, the direction that it's going, things like that. So it's not a fixed number. It moves around too. The black line's not hedgeable. So this is an important thing is, the black line is the liquidity premium component, if you will, of the cost of funds is not hedgeable. So there's an embedded risk in there that in that 120-day rate commitment period, if that liquidity premium goes up, your margin gets squeezed, and vice versa, right? The reason I mention that is because if you look at, and we'll talk about some of these spikes a little bit as we go through this, but if we look at the red line, that's the overall cost of funds since the beginning of the fiscal year. So we're going back to last November, and you look at, first of all, the volatility. We had a very volatile year. I went back and I took the absolute value of rate movements on a daily basis and added them up, right? The total rate movement in the year was 1,000 basis points.
Holy smokes.
And you think of a 250 business day year, that's like 4 basis points a day in any direction, right? Bank of Canada moved their rate 150 basis points.
Yeah.
So just to put it into context, right? Bank of Canada moved 150. Our cost of funds moved up and down 1,000.
It's insane.
Right. So
looks like my EKG.
Mine too. Mine too. And if you look at some of these spikes in the red graph there, the first one there in the fall, last fall, was Trump getting elected. And you can see how the market reacted to that. Cost of funds went up. If you look back on the left-hand side to see where it came from the blue line, the bond market, not so much the black line. So bank credit didn't really react, but the bond market did, right? If you look at the next spike there, that was in January, that was Trump's inauguration. But look at the spike up.
Yeah.
Same thing. If you go back over here, you see the blue line, it came from the bond market a little bit, but not so much in liquidity premiums, right? And then you look forward to April, the next big spike there, that was Trump's Liberation Day, as he called it, beginning of April.
Yeah.
Came out with the tariffs and, some of the Canada, commentary, 51st state and all those types of things. On that one, the bond market surprisingly didn't really react that much, but look what happened to liquidity premiums. Liquidity premiums spiked way up in April. And remember, they're not hedgeable.
Yeah.
So that was a period of time where all banks were getting squeezed on their commitments that they had in their pipeline, and stuff that was funding around that time, was under quite a bit of pressure.
Clearly.
Right. Not hedgeable pressure. Right. And then if you look after that, things kind of start to settle down. Right. If I go back to that 1,000 basis points of volatility, 2/3 of that happened in the first half of the year. The second half of the year, only 1/3. Right. So, and you can see in the red line, more stability, markets getting more used to the trade rhetoric, and you talk about that, and not hanging on every announcement in the media type of thing, like what was happening earlier. And so we've seen some settling down, and then more recently declining coming from the bond market. Again, liquidity premiums have been pretty stable. There's no kind of perceived risk of banks, being any more risky, Canadian banks, like those type of things that you would see in elevated liquidity premiums. We've seen that settle down. And so sort of the last couple of months, we've seen the overall cost of funds come down, a couple of central bank rate cuts, in there too. So I wanted to sort of give people a bit of a sense of what's in behind the cost of funds, how volatile it's been. So going back to your point about the craziness at the beginning of the year, like this was why, right? Like we're trying to manage like all the volatility that was going on literally a daily basis. And it was tough for everybody to manage through that.
When I think about pricing, and I would say most mortgage brokers in the country think bond market, where's the bond at today? And they think for some reason, things are going to change. And in some cases that is the case, right? But just understanding this liquidity premium, the risk, and the fact that it's not hedgeable, I don't think many people, especially listening to your presentation, really knew that.
And they don't always move in the same direction.
Yeah. And that was the biggest learning for me, is that they can go in opposite directions.
Right.
Very helpful information. I appreciate that.
Yeah, good. I'm glad.
Thank you for tuning in. If you found value in this show, please subscribe to our channel on your preferred platform. We're available on Spotify, Apple Podcasts, and YouTube. Your support is incredibly appreciated. We also welcome your reviews and feedback, which are crucial in helping us deliver outstanding educational content. Feel free to share your thoughts. A 5-star review would be fantastic if you think we earned it. Lastly, a vital announcement about Backpack Buddies, our chosen charity for 2025. This remarkable organization addresses a hidden hunger issue many are unaware of in British Columbia. While school districts provide meals during school hours, numerous children face food scarcity at home, particularly during the weekends. Backpack Buddies steps in to support these vulnerable children, ensuring they have easy to prepare, familiar food for weekends. This is achieved through collaborations with schools and an extensive distribution network. Your contribution can make a significant difference. With just $20, you can give a child in need a food bag from Backpack Buddies filled with enough meals and snacks to sustain them over the weekend and more. Once again, thank you for listening and see you on the next one.